Welcome to the Financial Independence Channel. We're here to help you take control of your money and achieve financial freedom. Today's topic is the Federal Reserve raising interest rates. Now, I know what you're thinking. Oh great, just what I needed, more complicated financial jargon to decipher. But don't worry, we'll break it down in plain English and throw in a little bit of humor to make it more bearable. The Federal Reserve, also known as the Fed, is the central bank of the United States. It is responsible for implementing monetary policy in the country, which means it makes decisions about the money supply and how it is used. One way the Fed can influence the money supply is by raising or lowering the interest rate, which is the amount of money that banks charge to lend money to people and businesses. At its December meeting, the Fed decided to raise the interest rate by 0.5 percentage points. This means that it will now cost more for people and businesses to borrow money from banks. The Fed raised the interest rate because it wants to make sure there isn't too much money being used in the economy, which can cause prices to go up too much, called inflation. Inflation can be a problem because it can make the cost of living more expensive for people, and it can also reduce the value of money over time. According to the minutes of the meeting, which were released on Wednesday, the Fed officials said that they expect to keep the interest rate at a high level until they are confident that inflation is on a sustained downward path towards the Fed's target of 2% per year. They also said that they will pay attention to data and retain flexibility and optionality in their decisions about the interest rate. Fed Chairman Jerome Powell said after the meeting that while there has been some progress in controlling inflation, he still sees only halting signs and expects the interest rate to remain at a high level even after the increases stop. The minutes of the meeting also noted that no members of the Federal Open Market Committee, FOMC, which is the group within the Fed that sets the interest rate, expect the interest rate to be cut in 2023, despite what the market is currently predicting. In addition to raising the interest rate, the Fed has also been reducing the size of its balance sheet by allowing a certain amount of money from maturing securities to be rolled off each month instead of being reinvested. This program, which started in June, has caused the Fed's balance sheet to shrink by $364 billion to $8.6 trillion. Thank you for watching. We hope you found this video helpful and informative. If you have any questions or suggestions for future topics, please let us know in the comments. And don't forget to like and subscribe to stay up to date on all things financial independence. We appreciate your support and look forward to bringing you more content in the future. Thanks again and take care.